Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are here with George Gammon, Rebel Capitalist. George, thank you for coming on the show.
Thanks for inviting me.
Yes. Okay, let's start out like I always do. And what is your macro view of the world economy and financial markets today?
Well, I think you have to go back in time and look at history when you have past rate cutting cycles. And I think it's very interesting to look at the past rate cutting cycles that started with 50 basis points. So the last time that happened was in 2007. And oddly enough, September 18th, so 2007, which is the exact same September 18th that we had here in 2024, where they cut by 50 basis points. And most people think that when the Fed cuts rates, then the long end of the curve automatically goes down. And that would make intuitive sense, right?
Yeah.
But what's really quite fascinating is when you look at these past rate cutting cycles, it's actually the opposite what plays out. So when we rewind to 2007, CPI was around 3.5%. Maybe actually it was probably even a little bit lower, maybe in the 2.6. I think that the 10-year is trading right around 3.5. So I'd have to look at a chart. But the CPI, let's say it was right around 3%. Okay. And then if you fast forward to August of 2008, and by the way, the Fed started cutting rates from 5.25% in 2007, just like they started cutting from 5.25% in 2024. So another similarity there. And what happened is, let's say CPI in 2007 was around 3% when they started cutting. If you fast forward to August of 2008, the CPI was up to 5.6. So the CPI went up substantially while the Fed was cutting interest rates from, I think in August, it was right around 2%. So they cut from 5.25 all the way down to 2%, while the CPI headline was actually going up. And then if we get super focused on 2008, going into January, they were supposed to meet January 29th. And they actually had an emergency meeting in January 22, where they dropped by 75 basis points. And then a week later, when they were supposed to meet initially, they dropped by another 50. So they're dropping by 150 basis points in 1 week in January. While at the same time, the 10-year treasury from that point to August went up as far as the yield, right? So the reason I focus on that is because a lot of what happens in these rate cutting cycles is extremely counterintuitive, very counterintuitive. So a lot of the narrative right now is with the Fed has dropped too quickly. The economy was booming. They should have cut by 50 basis points. They're going to have to pause because now, they're going to reaccelerate inflation. And we're going to have to worry about the long end of the curve, the interest rates going up, and the Fed has lost control. When actually, if you look at it, this happens every single cycle. This is not something new that no, not at all. And of course, once we get to August of 2008, when that 5.6 print came out on the CPI, if you look at the Wall Street journals, and this is one of my favorite things to do, is look at the Wall Street journals that actually came out right around very significant times in history, like when the Fed started cutting or hiking or when the dot-com bust or something like that. And if you look at the Wall Street Journal that came out right after, the day after that CPI print from July of 2008 in August, everyone was talking about how the Fed's got to start hiking rates. They're going to have to start hiking rates at the end of the year. They've, unleashed the inflation genie. They cut way too much into an economy that, yes, the stock market was going down. The economy is not doing that bad. Unemployment, relatively speaking, is low and all these things, right?
Yeah.
When if you fast forward 2 months from there, as you know, interest rates were at zero. Just off a cliff, right? And then if we fast forward a year, the CPI went from, call it 5.4, 5.6, all the way down to a -2.
Oh, okay.
So that's not to say I'm predicting that for 2025. But that is to say that if you study history and you study these cycles, like we were saying earlier, a lot of what plays out is very, very counterintuitive. And the narratives that we're hearing in the market right now are the exact same narratives that you heard in cycles like 2007, 2008. So you've got to, I think it's very contrarian right now to say that interest rates will be lower at the end of, call it 2025. But that would probably be my base case.
Okay. And if Pat,
And I'll talk about the longer the curve.
okay, do you see deflation possibly in our future?
Possibly.
Okay.
I mean, it all depends. Like the yield curve has been predicting a slowdown for the last 2 years. And the yield curve is not foolproof, but it's right 95% of the time. So we have to give that a lot of respect, especially when you combine that with the sawmill.
Yeah.
And then you combine that with some esoteric stuff like swap spreads being negative. And I don't know if your audience wants me to get to those weeds, but we can talk about, swap spreads being negative and why that's another signal that especially global banks and the Eurodollar system are risk off. Very, very risk off, right? And then you look at the price of oil. I would give that as another example as to look at the demand side globally for oil. It's plummeting. It's sure the supply side's going up, which is pressuring that and taking it under 70. But even with the supply side being what it is, the demand side is going down to an extreme to where you have two wars, one in the Middle East, for heaven's sakes.
Yeah.
And plus you've got OPEC, those production cuts that they have, OPEC plus, they're at historic highs, right?
Yeah.
Those production cuts are higher than what we saw during the GFC. So if you just had normal production cuts from OPEC plus and you didn't have two wars, take that out of the price of oil, and we're at $45 a barrel.
Yeah.
So what does that tell you about global demand? What does that tell you about the health of the global economy? That tells you that, especially when you combine that with the U.S. Inversion and now uninversion, which is usually when the stuff hits the fan. It's not when the curve's inverted. It's when the Fed starts cutting rates, it steepens up.
Yeah, it steepens up. Yeah.
Right. So you combine all these factors and you see that, again, no certainties, only probabilities. But my base case is that we have a slowdown, contraction, recession, whatever you want to call it, in 2025. And when you have a recession, it's always disinflationary. So now a lot of people freak out when I say that. They say, what are you talking about? Look at the 1970s when we had stagflation. You hear that all the time, stagflation.
Yeah.
Okay, fine. Well, let's just go back and look at the 1970s. When you had the recession and call it 74 and 75, 1980, like all recessions, you had that big spike right in the middle of unemployment. So if you look at that spike in unemployment, and then when you start to get that recession, official recession from the NBER, right? We always have disinflation, even in the 1970s.
Okay.
So I'm not saying that we had deflation.
Yeah.
But I'm saying that from that point, 75, call it, we had the rate of inflation going down.
Yeah.
When we had a recession, it never goes up.
Yeah.
It only goes down, even in the 1970s.
Okay.
So I don't know why. And I'm not saying that the CPI headline right now at 2.6 is accurate.
Yeah.
I totally agree with everyone that it's really probably 5, 6, maybe even higher. And everyone has their own inflation rate depending on what you have to buy every single day.
Yeah.
Right? But that doesn't mean that just because we've had massive amounts of consumer price inflation that no one denies, that we will go into this recession and it'll somehow be different than every single other recession that we've ever had in U.S. history, even the 1970s, where the rate of inflation actually goes down. And to your first question, how much of a downturn will we see? Well, it depends on if we have a liquidity event. If we have a liquidity event where it just completely dries up like we saw during the GFC, is it possible that we actually had a quarter outright deflation like we had in 2009? Sure. Definitely possible.
Interesting. Okay. One thing that you're talking about with oil. Okay, so global demand for oil is coming down. I'm a TA, a chart guy, and looking on the chart, there's quite a bit of support, I'll call it now, around WTI $67, $64, but it continually hits it. And when you see that technical thing, it's kind of like a wedge coming down.
Yeah.
And that would definitely support your thesis that, we could be heading towards $50 oil or lower.
Yeah, I mean, there's no denying that if you had normal OPEC constraint on supply, and you didn't have those wars, I mean, we would be like 45, 50, right? And if you look at even $50 oil, and that's nominal.
Yeah.
That's nominal. Go back and look at, I'm sure you have, at charts adjusted for inflation
Yeah.
of oil prices. Whenever they get below like 40, oil is very cheap, super cheap. And it's usually cheap not as a result of the global economy booming, right? It's usually cheap for the opposite reason. And again, people will argue, well, we have supply increasing in the United States and it's drill, baby, drill. Yeah, I get all that. But you've got to not just look at the supply side of the equation and come to the conclusion that that explains the price being, let's just say, at 70. No, a lot of that is forward-looking demand globally on the decline. And, we get hyper-focused on the United States for obvious reasons. Yeah, because we're all American. But you got to look at China. China right now is literally in a GFC. Like, people don't understand that. Like, people like, oh yeah, you're being hyperbolic. No, I'm not. Just look at what's happening there.
Yeah.
The Chinese real estate market was the largest asset class in the world as of about 2 years ago.
I just saw that.
Yeah, $60 trillion. The largest asset class in the world was Chinese real estate.
Wow. Okay.
It's come down by 30%.
Huh. Okay. Wow.
So what that means is you've got about 18, we'll call it $20 trillion of household wealth in China is gone. Gone. And 70% of household wealth was in real estate.
Wow. Yeah, that's a GFC. Yeah.
So you think about what aggregate demand looks like for the average consumer, or aggregate demand looks like in China, and then look at that through the lens of the average consumer. They are in extreme amounts of financial pain right now. Very similar to what we would have experienced in 2009, 10, 11. That's what they're going through literally right now. And that's the second largest economy in the entire world. So, and then you say, well, that's just China. Who cares? That's not the United States. Okay, well, what you have to do is you have to understand that we are in a very, very highly connected global economy.
Yeah.
And it's difficult. In fact, I would challenge any of your viewers to go back in time and try to find when we had a recession in the UK, in Europe, which they're pretty much in right now in Europe, especially Germany.
Yeah.
But then, UK, who knows, are probably on the edge. And you look at China, you look at Japan, you look at all of these major global economies that are close to, if not in contraction, look at Canada, for heaven's sakes. I mean, their unemployment rate is really skyrocketing.
Yeah.
So you have all these global economies that are close to, if not in contraction. And then you have the United States as the outlier. And you say, okay, well, in history, how often has the United States or any one of those countries been a complete outlier when all of the others are in recession? It never really happens.
Yeah, that's interesting. Yeah, you're right. I mean, China is 1 out of 5 people or something on the planet. What happens there is going to affect the rest of the world.
Yeah, and you're seeing that expressed through the price of oil. Yeah, that's really my point.
Okay.
And so when you're looking at the United States and then looking at it through the lens of probabilities, as far as what the yield curve is telling you, the SOM rule, negative swap spreads, the price of oil, then what's happening to these global economies. And by the way, look at other central banks. Look at the Bank of Canada. Look at all the South Korean central bank, the Bank of New Zealand, all of these other, the ECB, they're all dropping rates and dropping rates very, very quickly. Look at the Swiss National Bank, the Swedish National Bank. They're all dropping rates a lot faster than they otherwise, or a lot faster than they said they would as of, call it 3 or 4 months ago. So it's just the Fed that's really where the narrative is all about maybe higher for longer. But it's like, really? I mean, maybe the Fed could pause and all the other global central banks are cutting at the exact same time, all the way back down to 0 or whatever they cut to. But it's very unlikely.
Okay. That's why the dollar, or the DXY, I should call it, is screaming higher out of that little box. I can see the chart in my head, but anyways, it's been a while since we've gone above 106 on the DXY.
And I mean, that could be a lot of different reasons. It could be risk off in the global economy, so there's more demand for dollars.
Okay.
Because whether we like it or not, the global economy sees the dollar as a safe haven asset, along with U.S. Treasuries. It is what it is, right? So if you see the dollar ripping higher, that could be one of the reasons why. And also, too, what's interesting is you've got really 4 dynamics that are possible with the U.S. dollar relative to other currencies, right? You got demand going up, supply going up.
Yeah.
Demand going up, supply going down, right? Demand going down, supply going up, and demand going down,
Supply going down.
So when you look at those first two, I like to focus on those in terms of risk on, risk off.
Okay.
Because usually what you have is when demand is going up and supply is going up, that's usually risk on.
Okay.
Risk on, risk on. So my example that I would give you would be 2000 to like 2011.
Okay.
When we, with the exception of the GSC, when we had all the boom in the emerging markets and China and all there was massive demand for dollars because everyone wanted to start that factory to build those widgets to sell them into the global economy because we had this massive expansion, right? And what they were doing, again, whether we like it or not, is to build that factory. They don't need Malaysian ringgits or whatever the hell. Even though it's in Malaysia, they have to borrow dollars to do that. So you see this risk on. You see a lot of the demand for dollars going up, the supply of dollars going up, because all these banks, they're like, screw it, we're not going to buy treasuries. No way. We would rather take that balance sheet capacity and lend it out into the real economy because we see all of these opportunities. So then what did the DXY do from 2000 to 2011 or whatever?
Down.
Go straight down, right? Where then since 2011, 2012, it's pretty much, for the most part, gone straight up to the point where now, like you said, we're at 106 or 107.
Yeah.
So you have to say, okay, well, why are we, now I think it's more risk off. We have demand going for dollars up because not everyone is gung-ho on the global economy, but they have to have those dollars to pay off that debt that they've accumulated over the last, let's just say 2 decades, and they keep rolling over or whatever it is. But at the same time, the banks now, instead of being risk on, are risk off. So you have the demand for dollars going up, but the supply of dollars going down, DXY up.
Okay. Interesting. All right. I think you kind of answered Score's question about, but maybe you can kind of touch on the long bonds here. So he's asking, George, what do you think of playing the long bond ETFs such as TMF and TLT going into 2025?
Yeah. So let me be clear. Over the next 2 or 3 months, I don't know that I'd be that bullish on the long end because of what we talked about 2007. The interest rates can keep going up. We could see the CPI go from 2.6 up to 3.5. Who knows? That's usually how these cycles play out. But the way they usually end is with the long end of the curve going down. Right. So if you fast forward a year, my base case would be long end a lot lower. So what I do for my own portfolio is instead of just buying the TLT, I would rather go out and let's just say take $100,000 and buy the short end of the curve.
Okay.
And then take the interest that I'm making from those T-bills, which is a lot higher than long end.
Yeah.
And then take the interest and buy calls on the TLT.
Oh, interesting.
So then I've got no downside risk.
Yeah.
To see so as an example, let's say that you've got $100,000. I'd rather take that 100,000 and buy, let's just say, 3 months, right?
Yeah.
And let's just say you can still get 5% on a 3 month, just keep the math easy.
Yeah.
So you're getting $5,000.
Yeah.
And I'd rather take that $5,000 and buy call options. On the TLT. So then
super leveraged.
Right. You're leveraged to the upside, then you have no downside to your principal.
Yeah.
So and that's what investing's all about, is making asymmetric bets.
Yeah.
Right. So there you got no downside, but you got a lot of upside.
Yeah.
And that's what I'd prefer to do as opposed to just outright buy the TLT.
Just outright buy the trade in the TLT. Okay. Interesting. Okay. What is your, I guess, highest conviction? We're a show on commodities here. So if you had to bet on a commodity going into 2025, what's your highest conviction?
I have no idea. 2025, I have my highest conviction would probably be gold, barring a liquidity event. If we have a liquidity event, the correlation of everything goes to 1. So gold's going down. Just like we saw during the GFC, when gold, I think it was from, you probably know better than I would, from August to September, something, gold probably went down by 30%.
I think that was exactly that. I think it was 30.
I took a massive dive right there. That was because gold was doing its job, ironically, because it was the only thing on the balance sheet that people could sell to actually generate the cash that they need. And therefore, everyone's sold gold, price drops. That's your buying opportunity.
Yeah.
If we don't have, we could have a recession in 2025. But it's just a balance sheet recession, very similar to what we saw in 2001, where it's on this catastrophic event.
Yeah.
It's just simply where the S&P goes down by 30%, maybe housing over the span of 3 or 4 years in real terms goes down by 30%. You get that balance sheet recession, unemployment spikes, you have a couple quarters of negative GDP. And in that scenario, I don't think gold really tanks because no one has to sell it in order to generate the liquidity. All the other, I would be a little concerned about going into a slowdown like oil and whatnot. But to be clear, I think longer term, that would be your buying opportunity. If I had to fast forward like 5 years or 10 years, I would probably put my money in probably uranium.
Oh, interesting. Okay.
Almost as an AI play.
Okay. Okay. Give us a quick couple minutes on uranium.
Well, the only way that you're going to, if AI is the future, and like I was saying out here, I think, obviously NVIDIA overvalued, it's all these things are crazy overvalued, but it doesn't necessarily mean that in 10 years, AI is not going to have a similar impact as the internet did. It's very similar to where we were in the late 1990s. So, the prices got way ahead of the fundamentals, and they come down in a crash, but it doesn't mean that the internet went away. No, it was still the future. Right? So I think it's something similar, but instead of playing that right now, expressing that through NVIDIA or Microsoft or whatever these other tech companies, I would probably rather do that through uranium, because you not only have the tailwind of AI needing that power. AI takes a lot of energy.
Yeah.
And so you think about, okay, where's that energy going to come from? Well, most likely it's going to come from nuclear power. And that's why you got Google and all these other tech companies are actually invest these
Green Island and all that.
Exactly.
Yeah.
Because they get it, right?
Yeah.
They understand that that's where the energy needs are going. So I like that, because, and then also too, Rick says this all the time. I completely agree with that. If you look at how global economies expand and grow, it's always the same process. And it's not where these people that are, poor and in the lower middle class in these places, it's not like they start using all of the AI, and no, they just go from eating, 1,200 calories a day to like 1,800 calories a day. And I think I have a better, maybe view on this, or I have an easier view, that's a better way to say it, than most people, because I live in Colombia. And I see this with my own eyes. I see it with my own employees, where they go from walking to riding a bicycle to riding a 50cc scooter to buying a little teeny weeny compact car to then buying a tiny SUV.
Yeah.
BYD or something.
Yeah.
I see this with my own eyes. It happens every single day. And I've seen it over the last 10 years in Medellin specifically, right?
Yeah.
Where people have followed this trajectory. So if you believe that the Colombias of the world are going to, and the people in Colombia are going to want to continue to improve their quality of life, which I can assure you they are, right? That means one thing, that we're going to need more energy.
Yeah.
Because energy is the economy. And you cannot have, I repeat, you cannot have economic growth and therefore an increase in standard of living if you don't have energy to supply that economic growth. It doesn't work.
Yeah.
You can't have one without the other, right? And so then you look at the overall narrative with the global elite and central planners and the green energy. Well, that's fine. They can have that, but that's going to have to include a lot more nuclear energy, which will have to include a lot more uranium. So you look at it from an AI play, you look at it from an expanding global economy over the long run, you look at it from all of the, and then you look at it from the green component of it, if you want to call it that, and the kind of narrative that's being built, those central planners, the World Economic Forum and what.
Yeah.
You can hate them. I hate them more than anybody.
Yeah.
But you still have to say, okay, where's the puck going, right? And in those three buckets, it's all very positive for uranium.
For nuclear. Yeah. Yeah. Okay. Well, that is catnip for our audience, because I don't think there's anyone that watches this show that doesn't own uranium.
Oh, okay.
All right. I led you right in.
Do tell. Well, maybe the contrarian play you guys got there is the options on the TLT. Yeah, that's what most of your audience doesn't own.
Where are you playing the uranium narrative? Are you any specific companies, or are you just playing the ETF, or are you buying the physical uranium?
Sprott.
Sprott.
Yeah, Sprott. But I haven't bought any lately, just because personally I'm trying to time. I don't know that I'd suggest your audience do that, but personally I'm trying to time it a little bit more.
Okay.
What's going on with the curve and the interest rates and all this more esoteric stuff that we talked about.
Okay. Yeah, we're at about 25% cash, so we're trying to catch the same thing. Maybe that's not enough. I don't know. What's your thoughts on that? On like cash position? Does that sound too much or not aggressive enough?
Well, I mean, again, that's why I like buying T-bills and then taking the interest and then making your bets, because effectively you're 100% cash.
Oh.
Or you can take advantage of any type of movement or any type of price action where it's on your watch list and it gets cheap.
Yeah. Okay.
Right? You can always liquidate those T-bills.
Yeah.
And anyway, I think, I don't know what I'd suggest for the average investor. For me, that's just the way I'm playing it right now. I've got two portfolios, really. And one is what I call kind of a Black Friday portfolio, where I really don't do anything other than if stuff gets super, super cheap. So if like in crises situations, I go in and buy, but there'll be 2 or 3, 4 years where I won't do anything.
Okay.
And usually what I do is I just sit in T-bills and gold.
Okay. Okay.
Just sit in T-bills and gold.
Okay.
And then wait for, a housing crash of 2009, 2012, and go in and buy as many houses as I possibly can with that dry powder. Or I wait for like a Cypress. Remember Cypress, 2013? Example of when I went in and I bought a lot of shares there because the stock market was down by like 99%. That stock market, right? I like to, Jimmy Rogers says it really well. He says, I always like to buy panic and sell hysteria.
Yeah.
So for me, that portfolio just sits and does pretty much nothing until I see some serious panic.
Yeah.
And then I go, or COVID was another example of that. Where March 2020, I was in there buying hand over fist, especially the oil producers. And it was not easy. I can assure you, we can sit here and talk on these videos about how you got to buy low, sell high, buy low. And everyone agrees. Every single person watching right now will agree. That the problem is when it's the right time to buy, when stuff is cheap, that's when it's the hardest psychologically to pull the trigger.
Yeah.
Says you're thinking it's going to go down by another 50%.
Yeah.
And this is the exact same way that I looked at oil in 2020. I was in a tough position because I'm like, George, you've been saying on your videos that you got to buy stuff when it's cheap. This is cheap. It's cheap right now. But then on the other hand, you got the angel on the other side of your shoulder, or the devil or whatever. And you sit there whispering in your ear saying, don't buy now. Are you crazy? The world's coming to an end. We're going to go into a great depression 2.0, and the stuff's going to go down by another 50%. But fortunately, I stuck by my guns. And when things got, oil as an example, when it got under, 25 a barrel, I was loading up on the producers, even though it went lower, a lot lower, but still that was the right place. So the other portfolio is where I have gold, the treasuries, and I try to mix it up with options. Sometimes I'll buy options on the NASDAQ if I'm, feeling frisky over the next 2 or 3 weeks if I think there's going to be a big price move.
Yeah.
Or longer term TLT. What I'm doing there is just trying to look at the market and see when it's offside as far as the narrative.
Okay.
So like you've got, everyone on this side of the boat. Like right now, everyone is on the interest rates are going higher side of the boat. Like you just watch CNBC. You count how many of the talking heads that they have there in a row that all say interest rates are going up. Whether it's Druckenmiller, whether it's Paul Tudor Jones, every single person that comes on CNBC is saying that interest rates are going up. Okay, well, that would be an example of where I might take some of that interest that the government's paying me on those T-bills and maybe take the other side of that bet over the next month or so.
Yeah. Okay. Interesting. Yeah, that oil bet was the best trade of my life. That was awesome. Never forget that.
Or, short, even though I might be a little bearish on oil going into 2025, short term, we could, and you'd know this better than I would looking at the technicals, we could be way, way oversold.
Yeah.
Way oversold.
Yeah.
Where everyone right now is on the side of the boat that oil's going to 50.
Yeah.
So over the next month or so, you could get a good opportunity of a pop in the price there. But I think you've got to compartmentalize strategies, right? What most people do is they don't have a strategy and they just kind of get reactionary.
Yeah.
As opposed to setting up your portfolio and understanding, okay, with this side of it, I'm going to implement this shorter term strategy.
Yeah.
And in this side of it, I'm going to have a completely different view with a more longer term strategy.
Yeah.
And so, I spend a lot of time. I'm fortunate to have some real good buddies in St. Bart's that are former hedge fund managers. And a lot of them still trade their own account. So I'll sit there and hang out with them while they're trading. And what's really incredible watching these guys that have been so successful for the last 40 years is it's not just one strategy they employ.
Yeah.
I mean, they have like literally probably 100 different strategies that they're an expert in. And what they'll do is they'll just see whatever's happening in the market, and they'll just be like, oh yeah, today I'm going to do this, blah, 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 because this is, and sometimes it's super, super simple.
Yeah.
And these are guys that are, I don't name any names, but some of the top hedge fund managers in the business over the last 40 years.
Yeah.
And as an example, one guy will sit there and just say, like he did this in the NVIDIA's earnings call. He knew that usually the price goes up going into or it wasn't an earnings call, when the guy did the whole presentation.
Okay.
Where they did the thing in California, the Jensen guy. I forgot. It was like, yeah, it was like a show. He's like, watch. This was the morning. He's like, the price is going to go up until the guy goes on stage, and then it's going to tank. So he just did this. Like I've seen it 1,000 times. It always happens this way, right? And so that's an example of a little strategy that he had.
Yeah.
And he just did like day option
that expires at the end of the day or something.
He's like, let's do this. And he made like, I don't know what it was, 15, 20% on his money. He just sold right before it. Sure enough, it just goes down a little bit. And it could be that simple to something that's far more complex.
Yeah.
Right. Where he's structuring trades and whatnot. But he's just got all these things, and it's just through 40 years of experience that he has all these tactics and all these strategies that he knows about. He knows not only what they are, how to implement them, but when to implement them based on what's happening. And it's really fascinating to watch. But I think for the retail investor to have maybe two portfolios, two strategies, that's probably enough. Just don't mix them.
All right. One last question here from the listener, Jake. He says, George, you often mention that you have not been formally educated in finance, yet your grasp on highly complex economics is formidable. Flattery will get you everywhere. How did you start your self-education?
Well, I retired in 2012, and as an entrepreneur, to be successful, you got to know what you don't know. That was always the saying we had. Got to know what you don't know. And so fortunately, I didn't let ego get in the way. I knew that I knew nothing about investing, but I didn't want to delegate that to a financial planner. So I really wanted to take the bull by the horns and start learning myself.
Yeah.
So I just happened to stumble across YouTube videos of Milton Friedman.
Oh.
Free to Choose.
Okay.
I didn't know who the hell he was.
Okay.
It was 2012. I didn't know what the Fed was. I didn't know what a yield curve, nothing.
Zero.
I was just an entrepreneur. And then that just took me down the rabbit hole from Milton Friedman. I started watching Thomas Sowell and Jim Rogers and Jim Grant. Most of the speakers here, this conference
you have on your show, and
And so I started listening to them because they really resonated with me. Their strategies, and so then when I started investing in real estate in 2012, then when I was going to all my properties or doing whatever, I was just listening to podcasts and audiobooks and every single video I could find on YouTube with Jim Rogers as an example. I would just watch it over and over and over and over and over again. And I just became completely obsessed with it.
Okay.
And I'm always trying to figure out how stuff works. At the beginning, I didn't know how anything worked.
Yeah.
And they'd say stuff on a podcast that I wouldn't understand. And so I'd go back and rewind it and listen to it over and over and over again. And then a lot of times I just write it out on my legal pad, which is now, the whiteboard. And I'd figure it out. And it was just that process that got me to where I'm at.
That's awesome. Yeah. I love your whiteboard videos. I feel like we should have a whiteboard right here. George, any final words? How can people get in touch with you, follow your work?
Oh, they can just go to YouTube and type in George Gammon or Rebel Capitalist. You go to Twitter if they like Twitter and just type in George Gammon.
Okay. All right. George, thank you very much for being on the show.
This was a
pleasure. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. Have yourself a great rest of the day, and we will talk to you next time.